Well, good morning. It's me, ｃｈǐჯǐჯǐჯǐჯǐ, your host of the party, and today is January 8th, 2024, and I'm coming to you live right outside of the Fox Business Studios as I'm here in New York City this week, and it's a little bit chilly. This ain't South Florida by any stretch. It's about 40 degrees out this morning and just a little bit chilly, probably going up to maybe 45 degrees if we're lucky. In any event, here are the things that you need to know about the coming week, right? And so this morning we see that the selling is continuing. It continued last week and it's continuing again this morning. Boeing getting whacked again as a door plug blows right off the side of the Alaska airplane while it's in flight. Oil is down this morning as the Saudis cut prices and supply rises. Gold is testing support. And what do we have for dinner tonight? We're having the roasted cherry tomatoes with roasted garlic and ricotta cheese over thin spaghetti. So easy to make and so delicious because I made it yesterday for brunch at my daughter. So now the winning streak is coming to an end. And while 5 of the 6 indexes did end Friday a bit higher, the first week of the new year was a bit more difficult as we saw a pullback in big tech, with Apple getting a couple of downgrades to kick off the new year, which, as you know, I find very interesting because both of the guys that wrote those negative reports on Apple wrote them in December, right? But they chose not to publish them in December. Why? Because no one would have paid any attention. So what do? They wait until the first and second day of the new year to publish, making all kinds of headlines for themselves and their firms, right? As if they said something new, but they said nothing new at all. The information contained in those downgrades was information that we already knew and had. But because we were in this well overextended area, both in Apple and the broader market, and it was a new year, those downgrades lit the fuse and gave people a reason to hit the sell button and look and take some profits in the new year in big tech and then the broader market, right? And avoid paying any taxes for another 16 months until April of 25. And so at the end of the first week, we saw Apple give up 6%, while the NASDAQ gave up 3.25%. Now, just to note, Apple is now down 9% from the December 2023 high. The other indexes got hit as well, with the Russell leading the way, down 3.75%. The Transports gave up 2.5%. The S&P lost 1.5%. The equal-weighted S&P was down 1.3%, and the Industrials losing only 0.6%. So I guess you could say they're in the lead, right? At the end of the first week, we had the last year's underperformers leading the way higher. Healthcare up 2.5%. Utilities up 1.9%. Energy up 1%. And consumer staples flat, which is a win considering it's not negative, right? The other 8 S&P sectors were all lower. Tech and consumer discretionary, the first and second place winners in 23, are now down 4.4% and 3.5% respectively. Further down the line, we've got disruptive tech, think Kathy Woods' ARC, down 6.6%, semis down 5%, cybersecurity down 4.5%, and AI down 5%. Again, you see a little bit of a pattern here. Those Apple downgrades infecting the whole tech sector, right? Giving investors the reason to take profits and sending tech and the broader market lower. Growth, which outperformed value last year, has now been flipped on its head. The value play, the SPYV, is up 0.2, while the growth play, SPYG, is now down 3% on the year. But as we discussed in December, this action should surprise absolutely nobody if you've been paying attention. On the contra side, the trades that get you short the market are all up. SH is up 1.7%, the DOG is up 0.75%, and the PSQ is up 3.3%, and that makes sense. That represents the NASDAQ, right? The VIX, which was at historic lows for months, is now beginning to lift its head. It's up 7.3% in the first 4 days, and that speaks to the building underlying fear of more of a correction coming, and we could see that starting this week, right? As the start of earnings season, which kicks off on Friday, January 12th, with the big banks, JP Morgan, Citibank, Morgan Stanley, Wells Fargo, Bank of America, etc. Now, yes, you're going to pay attention to sales and trading and investment banking and net interest margin and all that stuff, all the usual components. But you also need to pay attention to the loan loss reserve account. And why? Well, because the loan loss reserve account is an account where the banks put money and they hold this money to provide money to cover the loan losses that they may expect. Think default. Over the last 3 or 4 quarters, we've seen them fund these accounts aggressively. And that speaks directly to what they expect is going to happen in the months ahead. Right. An ongoing increase in that account suggests to me that they expect tougher times ahead. Think credit card and auto loan defaults for sure, as well as mortgages and the like, which are and credit card and auto loan defaults are already at 10-year highs, according to Equifax, with low and middle income Americans being hit the worst as they choose to pay the rent or pay for food rather than pay the credit card or the auto loan, as inflation continues to take a toll on their pocketbooks and their wallets, right? Now, remember, earnings estimates during last quarter, they've all been revised lower as we moved into the end of the quarter. So now we can expect to hear all these companies are going to beat the number on both the top line and the bottom line, hoping to send a positive message out to the marketplace. But look, you don't buy stocks based on how they performed in the last quarter. In fact, you listen to that, you can appreciate that, but you buy stocks on what they suggest the future and the future guidance is going to look like. Remember what they did in December to FedEx, to General Mills, and to Nike when they issued their cautious guidance in the months ahead, right? They knocked those stocks down significantly, down 12%, both for FedEx and Nike, 4% for General Mills. Now, my friend Tommy Lee of Fundstrat fame makes note that the downbeat tone of the holiday week signals rough waters ahead for equities, at least in the first half of the year, which I agree with. He goes on to tell clients that, and I quote, "The first 4 trading days of 2024 have been a terrible start for equities. The year tends to play out in January," meaning this turmoil in the first week of trading is telling us to do what? Brace for a challenging year. And while the tone has not been robust, it's still very early in the game. But it does point to the point Tommy Lee is making, right? Brace yourself for an interesting and what could be kind of a volatile, bumpy road, at least in the first half of the year. Now, bonds also came under a bit of pressure on Friday. The TLT lost 1%, the TLH gave up 0.9. The 10-year bond shot up and through 4% and is now yielding 4.04%. The 2 years yielding 4.38%, while the 30 years yielding 4.2%. The shorter duration 3 and 6 month bills are yielding 5.21% and 5.03% respectively. 12-month CDs are still paying you about 5.3%, and your government money market account is hovering just around 5%. The move up and through 4% on the 10-year bond will be a headwind for stocks, especially if the expectation is those yields will continue to rise. The January FOMC meeting is on January 31st, and right now the expectation is for no change in rates. But once again, it's going to be about the guidance and the expectation. Understanding that Dallas Fed president already said over the weekend that don't expect rates to go down before they go up again. Now, oil traded higher last week. The ongoing tensions in the Mideast and the chaos in that the Iranians are creating in the Red Sea being blamed for that action. This morning, oil is trading down 90 cents at 72.88 after the Saudis cut their official selling price due to the perceived persistent weakness. And I say perceived because it's not a demand issue. It's a supply issue. Supply from the non-OPEC members is expected to remain strong. Think the United States. And that's not going away. Demand also remains strong, so don't misinterpret this move. This is to weakening demand. It's not weakening demand, it's just oversupply, right? This leaves oil in the $68 to $75 trading range. Now, if you see oil break 68, then we can expect it to go to 65 in rather short order, a level that it's tested, 3 or 4 times since March of 23. A breach of 75 is going to be much more difficult to accomplish, right? The trend line suggests that there's plenty of supply, right? There are plenty of sellers at that level, so just sit tight and we'll see what happens. Gold remains in the 2,030-2,100 trading range, rising over the past month on the expectation of those 5 to 6 rate cuts, which were ridiculous. But after the release of last week's FOMC minutes, that narrative has changed, leaving many to ask, can we even expect one cut? And gold, like the market, has now come under pressure. This morning it's down $14 at 2,035. The short-term trend line is 2,028. This is key. A failure to hold the trend line will see a challenge. The next 2 trend lines are 2014 and then 1998. The risk in gold is to the downside based on this new narrative. So just keep that in the back of your mind. Now, this morning, U.S. futures are down. No surprise. Dow futures down 180, SP's down 11, Nasdaq's down 40, the Russell's down 5. Boeing down 8%, and Boeing is both a Dow and an S&P name. On the news over the weekend of that Alaska Air Boeing 737 MAX 9 panel failure. The one that saw that block door exit blowout during takeoff when the plane was ascending at over 16,000 feet in year. Now, while they avoided tragedy, they're not going to avoid the intense scrutiny that's sure to come. Not exactly what Boeing needed, right? This event has resulted in 170 Boeing 737 MAX 9 planes worldwide, representing just 1% of the fleet, being grounded. And this morning, the stock is quoted down 8%, or $20-ish, at $228.50 a share, leaving it down 13% year to date. Alaska and United Airlines expected to be hit the hardest, but I would expect weakness in the whole sector, at least for today. Spirit Aerosystems, SPR, the manufacturer of the door plug, is also quoted lower, down 16%, or $5 at $25.50, $26-ish. Now, it's important to note, Spirit Aerosystems is not Spirit Airways, right? Now, recall what I've been saying since the end of the last year's robust rally. I expected to see some selling in early January, just based off of that move. But I'm also urging caution as we move closer to the start of earnings season. The story here is that companies are expecting a slowdown, right? Think weaker forward guidance, and that means that they're going to start to lose some of their pricing power, which is a positive for the consumer and inflation, but a negative for those companies, right, in terms of their guidance and their performance. So once again, do what Tommy Lee tells you, brace yourself. Now, there's no economic data today, but later in the week, Thursday, in fact, we're going to get the December CPI report, which is expected to be up 0.2% month over month and up 0.3% ex-food and energy month over month. Year over year, CPI is expected to be up 3.2%. All three of those readings are slightly higher month over month, while the year over year ex-food and energy is expected to come in at 3.8%, which is just slightly lower. Friday's going to bring us the December PPI report, which is expected also to be slightly higher month over month and year over year, right? Which once again forces us to ask, 6 rate cuts in 2024, really? I mean, come on, think about it. It's ridiculous. European markets are all a bit lower this morning. They're down about 0.4% across the board, with the exception of Germany, which is basically unchanged. Mamma mia, I'm freezing out here. British oil major Shell is down 2% after they announced a fourth quarter charge of about $900 million against earnings, which are due out on February 1st. You see, you get the negative info out ahead of the official call so that investors are not surprised when you make that official announcement, right? Hoping to lessen the fallout when that happens, which is usually the case since the news story is already priced in. It is when the company chooses to play I got a secret that they suffer even more. But that's a whole other story, right? These companies that don't announce the bad news until the day of, when they know damn well the bad news is coming. They're foolish not to pre-announce. Anyway, the S&P closed at 4697. It was up 9 points. Expect the narrative to remain fluid. Do not be surprised to see us trade lower in the days ahead. Another 150 points or so on the S&P, or 3%, would take us to the 4530, 4550-ish level, where we should find support because that's the trend line. In any case, there's no reason to panic. Even that move would leave us well within the normal trading range and represent a move of only 5% off the late December high. Now, in fact, a 9.9% move lower, which would take us to S&P 4300, would also be considered within the normal trading range. Uncomfortable, yes, but it would be normal. And think of all the bargains then, right? So put it in perspective, which is why I always tell you, talk to your advisor, create a plan, and then stick to it. Because that's the most important part, is that as a long-term investor, you focus on exactly the long term. Now, on a side note, remember what I said, Apple is now down 9% off the high at 181.18, and its RSI is now 28.7945, well into oversold territory. Remember, 30 is that indicator, which doesn't mean it can't go lower. It just means it's becoming way overdone. It's also sitting right on the long-term trend line at 180.15. A failure to hold that trend line is going to ignite the algos and send them into a selling frenzy due to a technical break, possibly taking the stock to a low of 170 range as the buyers step aside, allowing the sellers to take control and send the stock lower, because the buyers are just happy to buy it on weakness, right? They're not going to chase it. They're going to let the sellers come to them. In any event, let's keep our eyes on that. So what do we have for dinner tonight? So I made this yesterday. It is so simple, but yet so delicious. It's thin spaghetti and a roasted cherry tomato, roasted garlic, ricotta sauce, right? It's simple to make, takes you about maybe 45 minutes start to finish. If you have a glass of wine, it might take you an hour. You need 1 container of cherry tomatoes, which you're going to slice in half. You need 1 large bulb of garlic. You're going to slice off the top so you expose the garlic cloves. You need fresh ricotta cheese. You need salt, pepper, olive oil, butter, and fresh grated Parmigiano, right? You want to preheat your oven to 400 degrees. You want to bring a pot of salted water to a rolling boil on the back burner just so it's ready for when you need it. You want to begin by slicing the tomatoes in half and placing them in a baking dish. Then place the bulb of garlic right in the center, season it with salt and pepper, and then drizzle oil generously over the whole thing, making sure that you give a little bit extra to the garlic so it gets nice and goldeny brown when you roast it, right? You're going to place it in the oven and roast it for 35 to 40 minutes. Now you're going to, when that's done, after about 40 minutes, when you take it out of the oven, you're going to add the pasta to the pot of water. You're going to cook that for 8 minutes until it becomes a little bit al dente. That's it. Then you want to take those roasted tomatoes. You're going to take like 3/4 of them, put them in a blender. You're going to add the roasted garlic. You're going to push out the cloves, right? And you're going to add 2 big scoops of fresh ricotta cheese. You're going to blend that really well. Then you're going to add that back to the baking dish. It's got the balance of those roasted cherry tomatoes, so it gives it some pulp and some depth. Now you're going to strain your pasta, saving a mug full of water, right? You're going to add 3 or 4 slices of butter to the pot, and then you're going to add the pasta back in, so you coat the pasta with a little bit of the butter. Now add 2 ladles or so of the sauce. You're going to mix it well. You're going to serve those in warm bowls, and you're going to put extra sauce on the top and have the fresh grated Parmigiano cheese on the table for your guests. It is just spectacular. Enjoy this with a glass of chilled white wine. You can use a red, but if you're going to drink a red, drink a light red, because otherwise a chilled white wine always works well. In any event, here I am in front of the Fox Business Studios. It's about 40 degrees. My hands are freezing, and I got work to do. Until tomorrow, take good care.